You're at your computer, heart pounding, eyes glued to the screen. You've researched a particular stock or cryptocurrency for hours. Everything seemed perfect until the market turned. That small dip morphed into a gaping loss. You hesitate, unsure whether to exit or hold. And before you know it, a big chunk of your hard-earned money evaporates. If this sounds familiar, you're not alone. Many new investors and traders suffer the same fate by letting big losses gut their portfolios. Today, we're going to flip that script. We'll uncover why consistency and capital preservation are the real keys to long-term success. We'll talk about viewing every dollar as a soldier, each one working to bring more soldiers home. And we'll draw inspiration from cricket legend Virat Kohli, who didn't score massive runs by being reckless, but by staying at the crease, not getting out cheaply. By the end of this session, you'll understand how to protect and grow your portfolio steadily, how to stay in the game, and nurture your capital instead of watching it vanish in a single blow. In the financial markets, consistency is king. Flashy gambles might sometimes pay off, but true wealth building comes from disciplined, repeatable actions over the long haul. It's like running a marathon instead of sprinting. You don't need to hit a home run every time. You need to keep moving forward without suffering catastrophic setbacks. Consistent investing allows you to navigate volatility with confidence. It prevents emotional decision-making and ensures you survive to seize future opportunities. Without consistency, one bad bet can knock you out of the game entirely. Think of each dollar as a soldier. Your dollars head into the market with a mission, to return with reinforcements. If too many soldiers are lost in reckless battles, your army shrinks, making future gains harder. Protect your capital as if it were a well-trained unit. Don't send your troops into hopeless fights. Cut losses early and preserve your ability to fight another day. Consider Virat Kohli's approach in cricket. He didn't become a batting maestro by swinging wildly at every ball. He built his innings steadily, ball by ball, refusing to give his wicket away cheaply. That's how he accumulated big scores, by staying in the game. As an investor, you can't make consistent gains if you're knocked out early by one disastrous trade. Like Kohli, stay at the crease financially. Protect your capital so you can keep investing, keep compounding, and keep growing your wealth over time. How do you achieve this consistency? It starts with discipline and a clear plan. Know when you'll enter a position, how much you'll risk, where you'll place a stop loss, and when you'll take profits. This isn't guesswork, it's strategy. Avoid risking large portions of your portfolio on single trades. Even the best traders lose sometimes. The difference is they cut losses quickly instead of letting them spiral. Accepting small, manageable losses ensures you'll have capital left to invest tomorrow. Wealth doesn't materialize overnight. Compounding requires patience and steady growth. A 10% gain on a sizable portfolio is far more meaningful than a 100% gain on a tiny one. By preserving your base capital, you enable consistent progress. Over months and years, these steady gains add up dramatically. Kohli's centuries came from carefully selecting his shots over long innings. Similarly, your portfolio's strength comes from gradual, deliberate decisions over time. Markets are emotional roller coasters. Headlines, tweets, and sudden price swings test your nerves. But emotional trading leads to destructive decisions. Train yourself to remain calm. Stick to your risk management rules, trust your plan, and resist the urge to panic or chase quick fixes. Imagine starting with $10,000. A single bad trade that halves your account to $5,000 now requires a 100% return just to break even. Recovering from big losses is far harder than avoiding them in the first place. Consistency and careful risk management spare you from these crippling setbacks. Here's a simple blueprint. 1. Start small. Begin with manageable positions to understand market behavior. 2. Quality over quantity. Wait for the right opportunities. Don't force trades. 3. Clear rules. Define entry, exit, and stop-loss levels up front. 4. Journaling. Track and review your trades to continuously improve. 5. Probabilistic mindset. Accept that not every trade will win and manage risk accordingly. Just like Kohli didn't score big from the locker room, you can't grow your wealth if you're out of the market. Consistency keeps you in the game longer, letting you capitalize on future opportunities. Play it safe when conditions are tough, and press your advantage when they're in your favor. Don't chase excitement at the expense of stability. Often the most boring strategies, those focused on small, steady gains, prove to be the most effective. Just as a disciplined athlete endures repetitive training, a disciplined investor sticks to a process that may feel uneventful but leads to long-term triumph. Drawdowns happen. Treat them as lessons rather than catastrophes. Did you break a rule? Were emotions involved? Over time, you'll refine your approach and become a more resilient investor. Sometimes the best move is no move at all. If conditions aren't right, Staying on the sidelines can protect your capital. Just like a batsman leaving a ball that's too risky, an investor can pass on setups that don't meet their criteria. Study successful investors. You'll see they prioritize capital preservation and consistent execution over flashy gambles. They know that the secret to long-term wealth lies in a solid process, not in one-off windfalls. Keep records, identify your strengths, and refine your techniques. Resist the urge to chase every hot tip you see. Most big talkers don't show their failures. Stay true to your plan and trust the process. Markets change. At times, caution is vital. At others, you can be more aggressive. The consistent investor adapts without abandoning core principles. Like a seasoned player adjusting to different bowling conditions, you tweak strategies while preserving capital. Consistency grants you the freedom to build real wealth over time. Wealth that can support your future, your family, and your long-term goals. No single jackpot trade can match the reliability and scalability of compounding returns earned through discipline. This is your blueprint. Consistent, disciplined investing, anchored by rigorous risk management and the unwavering goal of protecting your capital. Think of Virat Kohli standing firm at the crease, and remember that you can't score if you're knocked out early. Embrace steady growth, value your soldiers, and never let one trade erase years of progress. Over time, this mindset transforms your portfolio into a formidable army, marching toward financial freedom. Consistency, though not glamorous, is the bedrock of lasting success in the markets.